Union Bank reported its Q4 numbers as well, and multiple numbers out there. And while income may be up just about 3% sequentially, let's hear out from the management to talk about who's talking to my colleague. The executive director is talking to my colleague on those numbers. Let's listen in.
If you are looking at our slippages, it was double what we are presently today, what we achieved it. So actually, we have taken a lot of steps for containing the slippages. The sequential what you are referring to is on account of, if you are looking at it, major will be from the agriculture sector, where the repayments of the seasonality depends on the repayment terms, and these are on the on year-on-year basis also. The last quarter, we have a challenge in the agriculture sector. But if you are looking at our actual slippages, if you are seeing that, out of this 11,800 crores, around 500 crores were the slippages which has happened of the NPAs of the previous year. There were some developments of bank guarantees, which has led to that 500 crores increase. And also, if you are taking into account our upgradation, which has happened, which are doing the slippages which has happened during the year, the upgradations happened, our net slippages is 9,556 crores only.
Understood, sir. Okay, I take your point. I want to try and understand this a little further. Your Agri book is roughly 20% of your total book. I want to understand whether there is still some bit of problem with regard to possible future slippages coming through in FY25. Is that how one can look at it, and what's the kind of number that one can expect it to normalize at?
See, the agriculture portfolio is, if you're looking at it, it is around 180, around major portion, around, if you say that around 30% of this is from the gold loan out of the, where we have a security of jewelries against that agriculture loans. So I don't find, because our agriculture portfolio will be always manageable. It depends on the climate condition, and when there is some delay in making the payments, normally there is a slippages, we are finding it in agriculture. But at the same time, you can look at it, once there is a good monsoon comes, these agriculture loans will be cleared, and the farmers will be again availing the loans. So we don't find much problems in the agriculture, because being a pan-India bank, we are also having a good exposure on all sectors of agriculture. So I don't find any problem. This will be taken care of on going forward.
Sure, understood. And therefore, where should credit cost normalize at? What's your credit cost guidance?
See, presently we have reduced our credit cost. Now it is around 76 bips. Though we are given a guidance that it will be below 1, we will be trying to manage at the present level.
Okay, understood. And sir, with regard to project finance, the latest draft, I understand it's in draft, but what's the impact? What's the size of your project finance book, first off?
Yeah, if you look at it, I first want to say that it is only a draft. We are yet to get to the full guidance from the Reserve Bank of India. At the same time, if you're looking at our portfolio, around 28% of my corporate book is project finance. Out of that project finance, also, if you say 68% of the projects have already been completed, and we are having a cash flow from the projects. So remaining 32% are under the implementation stage. So actually, even if today it is being implemented, what RBI as guideline has told, it is not a matter of concern for us. We can always manage the additional provisions.
Understood. I want to break this down for our viewers a little bit. So just in terms of the book size, on a 9 lakh crore book, roughly 45% of that book is corporate. And roughly 30% of that is project finance. So 15% of the total book is project finance, which is roughly 1.35 lakh crore odd. If I've got my math right, sir, you're better to confirm. Understood. Okay. And the second piece on this is, what's the impact, if at all, the provision is implemented as is? What's the impact like in FY25 and FY26 that you are forecasting with regard to your numbers? How will the numbers change?
Still our people are working out on a case-to-case basis how much actually the impact will be there on that. That is what I said. When on overall estimates, when we are looking at it, we don't find that it is not a very big concern and it is manageable.
Understood. And therefore, you will continue to maintain all your guidances as is. They will not change per se from a credit cost standpoint, from a provisioning standpoint.
Yeah, we want to maintain the same guidances.
Understood. Got it. Okay. Next off is I want to try and understand what's happening to margins, because margins have held up in a very difficult year otherwise. I also understand your yields have gone up to support margins. What should one expect in FY25? Because you've tempered down that margin number by at least 20 to 30 basis points. So do you expect some deposit, cost of deposit pressure to continue in FY25?
As you know, from our economic research team, we have a feeling that the rate cuts may be delayed in the current year. So we feel that the same pressure on the deposits are going to continue. Basing on that, though in the last quarter itself, we are given the clear indication that the next 2 or 3 quarters will be a challenge in maintaining the margin. So we have taken that saying that we will try to maintain between what, as you told, 20 bips less, we have given the guidance. But hopefully we want to maintain the margin at the nearest to the current level by which we are there. Okay,
so you're saying this is a conservative guidance and likely you will be able to hold margins above the 3% mark.
Correct. That's what we are.
Okay. Understood. With regard to therefore, where should ROA evolve? You've currently hit an ROA of 1%, come back slightly off. Is the ROA trajectory therefore upward, because the credit cost is what is putting pressure on ROAs, at least in this quarter? Hopefully that should ebb off in FY25 is what you're suggesting, and margins should hold up. Therefore, ROA should be in surplus of 1.2%. Would that rough math be correct in terms of my assumptions?
1.2 will be very high because we were able to show this ROA, but we will be trying to maintain the ROA at I think between 1 to 1.05 will be the.
Understood. And will be across all 4 quarters, you'll be able to clock the 1% plus across all 4 quarters. Is that the kind of comfort you have?
Yeah, I think we present, because we have taken various other steps. So we are having our plans in place, and we are very much hopeful that we will be able to maintain above 1.
Understood. What's the kind of traction you're seeing in corporate? Is corporate doing well at the moment? Is there good capex coming through? Are you seeing the capex cycle start to pick up, especially on the private capex side of things? Because we are seeing a lot on the infra side. But is core private, including manufacturing, picking up in your view?
Yeah, corporate, especially private capex cycle, is long overdue for our country. So I think now we are seeing some of the green shoots which are happening. There are a few projects which have been announced, and but I have to say that public's PSUs are already in the capex cycle. We are only expecting the private capex to pick up this year. So we also expect that this will be there, the capex cycle, which is already overdue in our country. It will be happening this year, and we will be able to show a good growth on that.